discuss market. Nilesh, good afternoon and welcome to ET Now. Let's start by understanding your thoughts on what's your philosophy in portfolio selection.
First of all, Ajay, thank you for inviting on the show. In terms of portfolio selection, typically we are stock picker and we are not a very value kind of a stock picking approach, but we believe and look for ideas of stocks or companies, businesses which have some differentiation. Along with that, we look for the revenue and earnings growth both coming in the near term. When I say near term, it could say coming over next 6 months to 1 year. And we also look for the change in ROC, the second derivative of ROC, if it turns out or looks positive, that is exactly how we pick the stock. We are very good, Ajay, in terms of looking for trends or broader trends in terms of sectors, the broader trends in the sectors. For example, like we were very early 2 years ago talking about capital goods, and we have seen very good result coming out of capital good industry. In fact, in spite of the market correcting by, let's say, from 18% now at 10-12%, but most of the capital goods stocks have made new highs. So that's the approach. Along with that, Ajay, we ensure that we have a very good margin of safety at the entry point. So our risk reward should be very favorable towards rewards versus risk. The risk we try and ensure that it could be more in terms of the time scale rather than the fundamental risk. So this is how we typically select our companies.
Nilesh, how are you analyzing the risk reward right now for Indian markets? It all got triggered by the correction in India started last October, triggered by sharp run-up in mid-cap, small-cap. The entire valuation had become slightly above, the comfort zone, which got accentuated by the war and then the rise in inflation. But are triggers, some of the triggers which started that correction, are they reversing permanently now?
Okay, this is a very nice question. So, in fact, you have highlighted a very interesting observation that the Nifty has corrected just 18% and now at 10-12%. But the erosion in stock prices in many sectors have been around 30%, 50%, 60%. Now, as you alluded, this erosion has taken place because of, during COVID, work from home, extremely pent-up demand, followed by over-ordering, over-inventorying, and a massive supply chain mismanagement. So all that resulted also into the commodity price spike. Now, why we are seeing this kind of a price correction is because consumer has overpurchased and now there is a huge amount of over-inventory sitting at the channel partners, including at the retailers. Especially we look at US because that was a very large market. And most of the stocks or sectors where we have seen these kind of correction is export-led. So we are observing this and we believe that all this process of inventory correction may take about another 5 to 6 months. We are seeing metal and commodity price inflation coming off from the peak. The prices have softened by 30-40%. So passing on these prices into the product has a lag of about, let's say, 5 to 6 months. And finally, the central bankers and government and everybody is addressing the inflation issue. So all that we believe that may take about another couple of months from here. And thereafter, we would expect that things would turn positive. So till that time, yes, we could be in a consolidation phase for that kind of a period.
Fair point. Nilesh, I'm tempted to talk more about capital goods with you because we saw the capital good leader this time around, L&T, engineering and capital goods leader, come out with good set of numbers, but the bigger highlight was they did not change their order inflow guidance and they retained it 12 to 15%. 30% their orders are actually overseas, and one would have thought that probably they would soften the guidance. That wasn't the case. And even some other capital goods companies, Schaeffler, SKF, Ball Bearing, a lot of mid-sized engineering companies, not only the results are good, but commentary is even more confident. You like that space. How are you playing it? If not stocks, tell us themes where the way you are playing the capital good journey.
So the way we are playing is, yes, we have some of these names. Also, the way we are playing is there are a couple of development which is unfolding in India as well as globally. One is we are seeing a lot of capex, infrastructure capex from the government. We expect a lot of PLI-led capex happening in the country, let's say beginning 2023. Thereafter, we have seen the volatility in the commodity price, which is cooled off. And now we are seeing some stability, which has hurted most of these companies' margin in the past few quarters. And finally, there is one more element which we are seeing. This could be a little green shoot, but we believe that there would be a reversal of a long globalization cycle to some deglobalization could take place, especially in the areas of, let's say, energy dependence, area of food dependence, in the area of oil and gas. So when we put all this into healthcare, pharmaceutical, so we believe that all this will help the capital goods companies in a better way. Second is a lot of our capital good companies, especially the Indian companies, have become Indian MNCs, and they have been spending last 10 years to develop and accept their product get accepted into the global markets. And we have seen most of these companies are very successful today. So that is also an additional opportunity which is coming for these capital good companies. And third, supporting capital companies, there are a lot of engineering good companies because which in turn would support these capital good manufacturing companies. So all this is a very good ecosystem that is getting developed. One, for domestic consumption, which is expected to go up. Two, their capacity is underutilized in many of these companies. So as capacity utilization kicks in, obviously their ROCE will improve. And third, now they are really geared up for global market. And added to that, because of this Russia-Ukraine situation, energy prices zooming, probably Europe has a very high energy cost, and their OEMs or a lot of corporates would turn to source some lot of these capital goods, for example, compressors, pumps, motors, and many of such things, switch gears from India. And all that we feel that really speaks very well for our companies in India.
Mm-hmm. Auto ancillary is also a space which you like, uh, and we have seen volumes come back for the space, passenger vehicles, CVs, etc. Two wheelers are still slightly on the softer side. How are you playing auto ancillary? Is it the traditional ones or are the EV tilted ones? How are you playing it?
So since the buzzword and the fancy, of course, is EV. But the way we are playing is in a very similar way, like we look at capital goods, because a lot of these companies have been trying for last many years to get entry into European market and the product made in India to European market. And it takes many years because for European or American OEMs to switch to Indian manufacturers or suppliers, it takes a lot of time. So typically they start with new models and then they give you an entry into old model, etc. But all these efforts we see are fructifying now. For example, in areas like there are companies who have started making, who make shock absorbers and now getting entry into European market. There are companies who are looking at automation and automatic transmission for Indian market. Now this is a very niche area, and we believe somewhere down the line, 3 5 years, probably all the passengers vehicle would be automatic. So we are looking this space very niche way and very selective way, especially where we see the product, the market share gain. Also, there are areas like Ajay, now castings. Now castings has been there in our country or globally very well. But now we are seeing that European manufacturers are looking at Indian companies to make heavy castings, very high weight castings. So we actually are looking at a very niche way to identify great businesses and great companies which are available with our margin of safety.
What about integrated textile stocks? That is also one space which you like. And do you think that this cotton price volatility, low demand issue in Europe or West for some of the exporting, all of that issue will be they will be able to tide out
Yes, so again, very nice question. We are looking at these companies who have capability today and now can scale up on this capability to cater to European markets, although they have been exporting to European markets. But there are two things developing. One is China plus one, which all of us know very well. And second is we are also expecting first FTA to be signed with UK, followed by probably the second FTA would come from Europe. And third, these companies are integrated. So the volatility in cotton prices or yarn prices, they are not affected. I mean, they start from sourcing cotton and finally they sell the garment or an apparel. Second important thing, Ajay, in these kind of businesses that it looks very simple that, to you start exporting, but that's not the way. To get a customer, it takes a long time. And once a customer comes in, he starts with a very small business. And then once he is satisfied, he accepts your product, he can understand your way of working. There are a lot of chemical specialty requirement in terms of this should not be poisonous colors and etc. The stickiness of this business is very high. So we have identified few companies which we feel that they can be slowly scalable, who can probably grow at 20-25% CAGR for next couple of years. And then second is once these companies are operating, let's say one shift gets into 1.5, two shift, I think the ROC also improves substantially.
In fact, Nilesh, as we are talking about integrated textile companies, KPR Mills results are just coming and flashing on the screen. Extremely strong set of numbers coming in by some of these textile companies. So demand really, market is fearing that demand may be impacted. These companies have not guided down on demand so far. Margin was the only issue which seem to have gotten arrested for now because cotton prices are sliding. Let's see how things go from here on. Thanks very much, Nilesh, for joining us on the show today. We will also speak more often from here on. But before we actually move